Hello and welcome to another learning session with College Guru 2020. My name is Anish John and today we have a very interesting topic to learn. Analysis of financial statements is indicative of evaluating the three main financial health status indicators of any organization. The income statement, also known as a profit and loss statement, the cash flow statement, and the balance sheet. Right from the leadership team to employees, market analysts, business promoters, investors, regulatory bodies, or anyone with interest in evaluating a company's financial health will be keen on looking at these financial statements. Expenses incurred, revenue generated, profit margins, EBITDA, assets, liabilities, goodwill, depreciation, operating expenses, cash flow into and out of the company could all be ascertained from analyzing the financial statements of a company. Let's try to understand the various headers or so-called line items generally found in a profit and loss statement. On top, you have revenue, indicative of returns generated from sales of products or services. Right below this comes cost of goods sold, which hints on direct costs linked to the product or services sold. When you deduct revenue from cost of goods sold, you get gross margin, also known as gross income. If you are keen on deriving the gross margin percentage, you could divide gross income by revenue and multiply it by 100. The next item on the income statement is operating expenses, also known as selling, general and administrative expenses, in short SGA. This comes right below gross profit. Insurance expenses, rent paid, utilities expenses, auditor or consultation fees, salaries and benefits to employees, depreciation, amortization, office stationery expenses are the common items classified under this header. Costs that are not linked to the production or the selling process are not accounted for here. Similarly, costs that are part of research and development does not come under general and administrative expenses. Deducting operating expenses from gross profit would give you operating income, also known as operating profit or earnings before interest and tax, in short EBIT. Interest expenses are due for any organization based on its borrowings. Interest expenses are incurred to help a company fund its operations, such as the purchase of additional machinery, plant, property, or even for the acquisition of companies. Deducting operating profit from interest expenses would give profit before tax, or in short PBT. Tax expense is the amount of tax due in a given period, and that's in line with accounting standards and also in compliance with tax rules of the land. Once tax due is deducted, you arrive at profit after tax, known commonly as earnings or net profit. This concludes our learning on different headers that are a part of the income statement, also known as the profit and loss statement. If you are interested in more learning videos like these, subscribe to College Guru 2020 and don't forget to click all under the notifications bar. Thank you and happy learning!